larger macroeconomic picture. A lot of clarity came in yesterday by the way of various decisions that were communicated. Of course, one was with respect to the Q1 growth coming in at about marginally over 7.7% at 7.8%. That being one, the government came out yesterday and the representatives of the government came out yesterday saying that we maintain that we are going to grow at an annual rate of over 6.5% in financial year 24. So maintaining that rate there, of course, and maintaining the initial projections of the financial year 24 GDP growth.
My only question to that is, Shweta, of course, these numbers augur very well. You say that, 7.8% fastest growing large economy out there in the world, right? And compare it with the peers, compare it, let's say, with China at 6.3%. And
UK,
that, of course,
Germany.
we discussed yesterday's made in China data. So, you don't know how much to trust that. Look at US. US growth projection, in fact, this morning has been cut down from 2.4% to 2.1%. But broadly speaking, I think 7.8%, the headline number looks great, but this headline number comes on the back of a 13.1% growth in the same period last year, which is Q1 of FY23, which came on the back of the same quarter the year before when we were smack in the middle of COVID.
Okay.
And that is when the economy had just about started recovering. So a Q1 to Q1 to Q1 comparison still suggests that 7.8%, while the headline looks great, may not be great enough. And then when you were to look at it in a larger context of a 6.5% growth for the financial year, it's well below the required target of 7.6%, which India is expected to grow at and needs to grow at to be a $5 trillion economy by 27-28 and among the top 3 economies of the world. So the point simply being that you might still get there. You might still be the 3rd largest economy. You might still be a $5 trillion economy. But what is the value of that 5 trillion 5 years from now today? You've got to discount it using inflation. So there's always this debate between real growth and nominal growth. And one is a factor of absolute term growth and the other is a factor of deflating that growth, taking inflation into account. So you discount that growth keeping inflation in mind. So if you were to look at the discounted growth or the deflated growth, we are still looking at a number no more than about 4.4, 4.6% or so when it comes to the inflation adjusted growth. So is that good enough? Second point, I mean, I don't want to sound cynical, right? Neither do I want to critique the hard work done by the services sector, by the government really heavy lifting the whole growth story by making large capex investments, and both center and the state governments investing big time into creating infrastructure. Obviously, all of this, go back to the formula of GDP, right? Y is equal to C plus G plus I plus X minus M. Consumption plus investments plus government spending plus the net exports, export minus import. On all these fronts, consumption has been robust. Even rural consumption has been robust. But this consumption, the headline figure of consumption also comes on the back of prices being high. Add to that government capex, yes. What about private sector capex? Private sector capex is yet to pick up. Now we are talking about Q1. Q2 is when we were actually hit with inflation. So what is the Q2 growth going to be? And over time, Q2, Q3, Q4, all aggregated to a 6.5% is not good enough to get to the targets that we have very, very ambitiously set out for ourselves. Now, you could get there, but would you rather be the 3rd largest economy with a weakening China? Would you rather be a 3rd largest economy with a weakening US, which is growing much slower at a slower clip than India? Or would you actually want to unleash those animal spirits and get capital investments to flow in from the private sector and really have the consumption story pick up? But this consumption story will be marred by high inflation. Add to that the fact that we are in election year. So where is that going to take us? So, maybe we could get a word from Kranthi, and then there's a nice little SWOT analysis that I have drawn up, which I want to come to.
Just one point I had to make as well. He was talking about 5 years from now, we're being a $5 trillion economy. There is inflation, you have to adjust for it. At what cost are we going to become this $5 trillion economy? In the 5 years, we're also discounting population growth. So your per capita GDP is going to go down 5 years from now. We need far more than 5 trillion. So
absolutely, a lot of important factors that Kartik packed in that discussion. But I want to first begin by asking Kranthi, how realistic are these numbers? You're talking about a $5 trillion economy, obviously would be attained in a due course of time. Will the target of 27, 28 be met? Or are you looking at turn of the decade to be a $5 trillion economy? Let's begin with that first.
Shweta, Kartik put the very good perspective, how the GDP perspective is concerned. But one thing we need to keep in mind is right now we are in a high interest rate environment. Across the globe, the inflation is the key concern, cause of worry for all the economies across the globe. So India also have the key concern at this point of time. One thing is the inflation that is creating pressure with respect to the growth is concerned. Right now, one good thing, the favorable factors for India is concerned on a medium to long-term perspective. The inflation can be expected, can be cooled off in the third quarter and the fourth quarter. But we need to wait and watch. And the second thing is the feelers that comes from the Federal Reserve always on the rate hiking cycle. Whereas in India, the good thing what happened is we don't have any kind of loose monetary policies or ultra expansionary monetary policies. RBI, thanks to Reserve Bank, the Central Bank of India, who maintained a strong emphasis towards the growth and inflation. They balanced it very well. So if the global environment is getting, the liquidity is getting skewed, India have that ample lever and the edge to take the advantage in between to maintain the perspective. So, but in a context of the growth is concerned, the advantage for India is the different segment of the economy. So, right now, the different types of capex, it can be right now. If you observe that the GDP data, the defense has emerged one of the key sector that's giving the comfort to the GDP numbers is concerned when there is a slowdown slightly with respect to the farm sector is concerned. So the segments of the capex in India is concerned, that's very interesting. So on a longer term perspective, what we can see is when the global inflation will come down, and that's where we can expect the coming years to the growth trajectory around 7 to 8%, which is crucial. Otherwise, our dream of achieving the $5 trillion economy can be delayed further. So that's where the crux one is. The RBI have the responsibility to create growth and balancing the inflation. That is a crux. But one good thing for the equity markets are concerned, the Chinese market, if you observe, they are too cheap to short right now, too large to ignore, too risky to invest. So for the global equity environment is concerned, India offers a best place for the investment is concerned, despite of certain achieving the $5 trillion economy with a slight delay.
All right, I quite like that analogy, Kranthi. Thanks very much for taking time out this morning. Thanks for your inputs. Thank you very much.